Fresh off the stock market's worst quarter since the COVID-induced downturn 2 years ago, many experts still aren't convinced a recession is in the cards this year, but some are warning the risks could keep rising through next year as the Federal Reserve eases stimulus measures, signaling more bad. The reopening economy, fiscal stimulus and historically low interest rates helped fuel one of the strongest bull markets ever during the pandemic, but stocks have struggled this year as the Fed raises rates and unwinds economic support to ease decades-high inflation. Uncertainty has come to a head in recent weeks, with the tech-heavy Nasdaq posting its worst month since 2008 in April, and data showing the U.S. economy shrank 1.4% last quarter despite expectations calling for 1% growth. The Fed has been very explicit and relatively unanimous in preparing March. The Fed concludes its next monetary policy meeting on Wednesday, when officials are expected to announce how aggressively they'll act to raise interest rates. For the first time in 22 years, the Fed is poised to raise interest rates by more than a 1/4 percentage point increment, and at consecutive meetings for the first time in 16 years, Bankrate chief financial analyst Greg McBride said in emailed comments Monday. After a 25 basis point hike in March, officials are expected to raise rates by 50 basis points this week, and as much as 75 basis points in June. Economy shrank 1.4% last quarter in worst showing since COVID recession, new GDP estimate shows. Forbes has inflation peaked? Fed's favorite indicator says maybe so, despite another startling reading. Forbes Nasdaq posts worst month since 2008 and Dow plunges 900 points. Market sell-off continues. Forbes.